Yes, hello and welcome back. I apologize for the long delay or the long break in between this part and the previous part, but nevertheless, we still have to talk about some exercise cases. So let's just focus on today's case. This is a simple one. Mr. X from Xanten, dies and leaves the following property to his only relative, that's his nephew Norbert Nobody from Xanten. Also, Xanten is in Germany. A house which has been occupied by the late Mr. X himself until his death. The market value is 400,000 euro. Norbert Nobody is not going to live in that house but plans to let it to tenants. There is a bank account of 112,300. There is furniture in the house with a value of 50,000 and a car having a value of 30,000. There is furthermore a house in Munich in the south of Germany with a market value of 800,000, which is let to tenants. And 5 years ago, Mr. X had already made a donation of 300,000 to Norbert Nobody. And in his last will, Mr. X has obliged Norbert Nobody to make a donation of 60,000 euro to the Red Cross. And your task is, and my task too, is now to find out how the case has to be treated under the rules of German inheritance tax law. You are to give, as always, every step which is necessary to arrive at the right solution, and to give reasons for every step you take, so for every decision on the road to the final figure, and to give, naturally, as always, references to the law, which are the reason or where the reasons for your decision can be found. So that is what we have to do, and so we should think about doing it. So naturally, the first step should be, again, that you take the tax acts, and then that you try to remember the testing scheme steps. So I believe that was first the taxable transactions, but the best idea would be just to stop the video here now, make a small break, take a sheet of paper, take the tax act files, and then try to sketch a solution of your own, and then later to compare with the solution which is going to come here. Naturally, what we need really is, is the Inheritance Tax Act, so the Erbschaftssteuergesetz here in Germany, and you probably remember that we need the taxable transactions, and have a good look to the case description if there is 1, 2, or more taxable transactions in this case. Okay, till later. Yeah, potentially we have, or we see here in the area, or in the headline taxable events, we see potentially 3 taxable events. That's first, the inheritance going from Mr. X to Norbert Nobody. Then we have 1.2, the former donation from Mr. X to Norbert Nobody. And I would perhaps even say this is just the first overview only. And then we have, last but not least, or perhaps last and indeed here, from the amount, the least, the donation which has to be made to the Red Cross. So we have potentially 3 transactions where we have to think about. And now, concerning number 1, the inheritance is an acquisition on grounds of death, That can be seen in paragraph 3(1), number 1 of the Inheritance Tax Act, and so it is taxable under 1(1), number 1 of the Inheritance Tax Act. Number 2, the former donation was a donation between living persons. That could be seen in 7(1), number 1 of the Inheritance Tax Act. At least I profoundly hope so. And we will have to check this to control it, if that's really right. So taxable under 1(1), number 2 of the Inheritance Tax Act. And number 3, the donation, that is ordered by a last will and testament, so it's an acquisition on grounds of death. 3(1), number 1 of the Inheritance Tax Act, so taxable under paragraph 1(1), number 1. Now I have to do something, because now proudly from my memory I just cited these references without checking them, and that is, as you know, always a high risk. So the next thing we definitively have to do is to find out if this here, this here, and this here are really the correct references for the statements and allegations which we made. So we have now to have a look into the tax acts again to check if we are right. So what we have to check was if an inheritance was really an acquisition on ground of death, if a donation made in accordance or on the command of a legacy to the Red Cross is an acquisition on ground of death, and if a donation between living persons, here from uncle to nephew, is really covered by paragraph 7. So let's jump to the table of contents and let's go to paragraph 3. And here indeed we can see that 3(1), number 1 covers both the inheritance and the legacy, so I quoted that correctly. And we have again now to look up paragraph 7, the definition. Sorry, that was a misclick. So here we have to check if paragraph 7 covers donation to a nephew during lifetime. And indeed, paragraph 7(1), number 1 says any generous gift or donation between living persons as far as the donee is enriched to it by it to the cost of the donor. So indeed, that seems to be right. That's good. First summary here, or first subtotal. So until now we are evidently right. So we are correct with the first step, and so we can go on with the rest of our solution. So the first thing which we can be sure of now is that this was correct, this was correct, and that this was indeed correct too. So sorry, do not need to worry about that. Now we have now to make a basic first decision, that is what is which of the 3 transactions are we going to talk about first. And as you perhaps remember, there is a rule in German inheritance tax law that if between the same persons several taxable transactions happened in the course of the last 10 years, they have all to be added up when it comes to the tax base. And then that later, when you have computed the total tax for everything, you have then to deduct the amount of tax which was already due and paid for the first of these events. So probably when we have to deal with the inheritance event between uncle and nephew here, it might be a good idea if we already know the treatment of the former donation of 300,000. So my proposition is, let's begin with that. So event number 2 tested first, and now this will probably confuse every reader, so I would strongly recommend also for you in an exam solution or in any solution which you ever want to present to somebody else, donation made by Mr. X to Robert Nobody in Xanten 5 years ago. 2.9, it's a taxable event. See above, that was already proven. Number 2, you remember the second step was the personal tax liability under which that is covered. And here you remember there was a limited and an unlimited tax liability. And I strongly seem to remember that if one of the two persons involved lived in the inland, it was a matter of unlimited tax liability. But naturally, when it comes to the reference, one has certain uncertainties, doesn't feel very sure, so as always, we will have to look that up. So unlimited tax liability because at least one of the two persons involved lives in the inland. That seems to be clear, and I believe that was paragraph 2, and for all the rest, and to be sure, we should look that up. And indeed, we can see paragraph 2, section 1. The tax liability covers the complete property transferred here, that's meant worldwide. If blah blah, the deceased at the time of death, that would be Mr. X, is an inhabitant of the inland, and that he is an inhabitant of the inland results from paragraph 2, 1, sentence, or number 1, sentence 2. As inhabitant of the inland is regarded any natural person who has a residence or habitual abode in the inland. That is the case both for Mr. X and for Norbert Nobody in our case, so everything's fine here. So 2.1, number 1, because naturally both or even both X and NN are inhabitants of the inland. See paragraph 2, 1, number 1, sentence 2, letter A of the German Inheritance Tax Act. Okay, now what was the next step? You remember that was the arisal of the tax, so the date which is relevant for everything which brings the tax burden into being. And so we also have, just think about that, 5 years ago. Okay, so we do not have a precise date here, but at least we can recur to the legal rule and say which date under the legal rule should be found out. And as you know, our case is per our rule, which we need is paragraph 9, especially paragraph 9.1. The tax arises in cases of acquisition on ground of death. Oh no, not what we need here. So evidently we have to look a bit further, because here we are talking about the donation. 9.1, number 2, in case of a donation between living persons at the time when the donation is effectuated, so performed or executed. So not when it's promised, but when it is really done. Okay, we do not have the date in the case. We only have the information that happened during the last 5 years, so it's not long enough ago in the past. So it still counts today, and it counted at the time. So 9.1 number 2, that is what we have to note down. So let's do that. So arisal of the text 9.1 number 2, at the time when the donation is effectuated, so performed, not promised. Date is here not given. That's yeah, that's just something which we should. Okay, this is not no longer in italics, but 2.4. Now the tax base. That was, if I correctly remember, something in paragraph 10, and I believe it was the enrichment of the acquirer which counts, but naturally we should look it up in order to be certain. And here it is now. The taxable amount is the enrichment of the acquirer as far as it is not tax-free. And oh, that's nice. The taxable amount is to be rounded down to full €100. Okay, if I remember correctly, that's not our problem, because it was an even amount of 300,000 which had been gifted. So paragraph 10.1, sentence 1 of the Inheritance Tax Act in Germany, the enrichment of the acquirer. So what Norbert nobody gets from his uncle here, that is simply 300,000. Yeah, to be rounded down or so, as far as not tax-free. So we have to look for tax exemptions, and there naturally it comes to our mind that there is a personal free allowance, which always exists, and so we will have to look to paragraph 16. But as the personal free allowance depends on the tax class, we will first have to look up which tax class a nephew qualifies for. So let's have a look to paragraphs 15 and 16. Okay, concerning paragraph 15, we find out that the tax clause 1 is for husbands, wives, life partners, children, stepchildren, the descendants of children and stepchildren, and the parented ancestors in cases where they still live when somebody dies. No nephew shows up. Tax clause number 2 is parents and ancestors in cases where they do not belong to tax clause 1, so where they get donations from their children, brothers and sisters, okay, and the descendants of in the first degree of brothers and sisters. And now I don't know if you remember what a descendant in the first degree is. That is a son or a daughter. So these are the nephews and nieces. So tax clause 2 is Norbert nobody. And now we should simply look to paragraph 16. So let's turn a few pages till we arrive at paragraph 16. What can we get as a free allowance for persons of tax class 2? And surprise, for all of them, only 20,000. So there are some nice pieces of information which we can now add to our solution. Let's do it. The nephew Norbert is tax class 2, see paragraph 15.1, tax class 2, number 3 of the Inheritance Tax Act. So the personal free allowance is 20,000. See paragraph 16. Let us look it up. What was it? 16.1, number 5 of the Inheritance Tax Act. So taxable amount is 280 euro. Okay. There seems to be no other reason why the tax base could be still lower. So we have, already found out everything. What we could have done is we could have thought about the valuation of the donation, but here it was not set what was given. It was only set the donation was 300,000. If it was cash, one would have been able to add that cash has to be valued according to the Inheritance Tax Act with its nominal value according to the German valuation law. But I think nobody will really debate about that. Okay, so we have now a taxable amount of 280,000. So we will now have to think about the tax rate and the tax. So let's take a new sheet of paper. 2.5. The tax rate. Well, as you perhaps remember, the tax rate depended on the tax class and the amount of money which somebody gets. So the taxable amount, it was progressive under two aspects. It is progressive with regard to the tax classes, and it is progressive with regard to the amount which was transferred. And so the only thing we can do is look up which tax rate applies to a transfer of 300,000 in tax class 2, sorry. And here we have it, 280,000. That was what we have to look up. In tax class 2, this is 20%. So that is what we needed. So we can now compute the tax. Tax class is 20%, paragraph 19.1, tax class 2. So here the tax is 20% of 280,000, that is 56,000 euro. Now you remember that one usually also has to make that 93 test. If a bracket has been exceeded by a small amount of money, then the leaping up of the tax rate can cause a negative or a more than 100% marginal tax rate, which is to be avoided by that specific test. The tax is then capped or limited at a certain amount. That was the again the tax for the additional amount of the tax which is higher than the tax at the last threshold, be paid out of 50% of the exceeding amount. Well, tax at the last threshold was or would have been 15% of 75,000. That would be 11,250. The difference to the last threshold is 280,000 minus 75,000, that is 205,000 euro. 50% of it is 102,500. Yeah. So naturally, the difference between the current tax and the tax at the last threshold was 56,000 minus 11,250. Sorry. So that would have been 44,750. And now it seems to be clear that 40,000 can easily be paid out of 50% of 205,000. So the tax is not modified, but the tax can be fully levied according to the tax tariff. Yeah. By the way, that was common sense because the last threshold had been exceeded by an enormous amount, and the next threshold was already, the next end of a bracket was already coming near. So that was to be foreseen. Good, so the tax remains unmodified. It is 56,000. Okay, now that was the treatment of the first of our cases. And now let's turn to whatever we like. The sequence is not programmed, so let's do the legacy given to the red cross. Well, it seems to be an easy one. Taxable event, yes, see above. Probably it would have been better to think about the organization, the overview, that there are 3 taxable events possibly first, and then to check them all. Probably it was too early to write about the taxable event in the overview. Probably it would have been placed better here, but that makes no difference. So is it unlimited tax liability, personal tax liability? And the answer is yes, because the deceased from whom the legacy has been ordered is an inhabitant of the inland at the time the tax arises. Paragraph 2(1), number 1 of the Inheritance Tax Act, because that was Mr. X living in Xanten in Germany. So nothing to say about this. The arisal of the tax, there we would have to look, or even worse, we have to look again into paragraph 9. When does a legacy cause a tax? So if we have a look here, we see that the tax arises in all cases of acquisition on grounds of death with the death of deceased person. So that also includes the legacy cases if there is no exception or special rule which deviates from that. So just to be sure, we check the deviation letters here. A, if the acquisition is subject to a condition, no, it is not. In case of a claim for a compulsory minimum legacy, no, that is not a compulsory minimum legacy. That's a legacy in the last will and testament. When the foundation is recognized, no, there is no order in the testament that a foundation has to be erected or established, no. And also the other exceptions seem not to take place. the rest, which later comes, refers to donations, special purpose transfers, and all the rest. So what remains is on the day of death, our tax arises. So paragraph 9(1), number 1, inheritance tax act of Germany. When Mr. X dies, the tax rises, and here no date is given. Just to make that sure, that's it down. The tax base is again the enrichment of the acquirer. So what the Red Cross gets. 10(1), sentence 1, but only as far as it is not tax-free, and so we would have to check the tax exemptions. You have probably somewhere in the back of your minds the idea that charity organizations, or as you could also call them, organizations working for the public benefit, that these organizations are very often privileged under tax law, and that, for example, who gives away all his or her property for the common benefit should not be forced to pay additional taxes on the same amount. So there might be a tax exemption for for transferring money by a legacy to the Red Cross. So let's look through paragraph 13 and what follows. So what we can see here is tax-free remain household property and other movable property in cases of tax clause 1. In cases of tax clauses 2 and 3, only 12,000 in total. Not our case. Number 3, real estate property. No, not our case. Number 3, real estate property. Not our case. Number 4, not our case. Not our case. Not our case. Not our case. Not an acquisition which goes to parents, adopting parents, step-parents, and so no. Some strange things not translated here. No. Taxable transaction going up to 20,000, which is kind of remuneration for persons who supported the disease with care or financial support, blah blah, and so on. No, 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 no. Donations to pension institutions, no. The usual things on the usual occasions, so birthday and Christmas presents, no. Acquisitions going to the federation, a federation state, or a municipality in the inland, no. 16. Grants to a religious corporation or to corporations or masses of property which are under the statutes and according to the actual way of management only and immediately following the aims of purposes of religion, of the public benefit, or of charity as defined in 52 to 54 AO. And yeah, that would be of interest. Or to corporations, associations, or masses of property from abroad as defined in letters A and B, which would be tax-free under 5.9. Well, now the Red Cross is not from abroad. So what we can use as the appropriate rule is number B, or letter B, corporations which are exempt from corporation tax or other taxes under the General Tax Code, the AO, the Abgabenordnung, as acknowledged, recognized charity organization, which the Red Cross definitively is. That is common knowledge. So the complete transfer is tax-free under paragraph 13(1), number 16, letter B, was the Red Cross is an acknowledged organization in the public benefit, for the public benefit. So taxable amount remaining is 0, tax 0, so that's it. This part of the case has also been solved, so now we can go back to the first transaction. That was now 2.3. Did I misnumber that? Yeah, I did. I believe 2.1. That should have been, let's go 2.2, yeah? 2.2, sorry. Oh, shit happens. Naturally, you will see similar typing mistakes when you make your own solutions. So this is now step 2, and the third variant. This is now the inheritance made by nobody. 231 taxable event. Yes, see above. We discussed that already in the introduction. 232 is now unlimited tax liability applies. That is again 2.1, number 1 of the Inheritance Tax Act, because at least one here, even both of the persons involved, was inhabitant of the inland. Of 2.1, sentence to letter A of the German Inheritance Tax Act, and 3, the tax arisal or arisal of the tax, so the date when the tax came into existence and which is relevant for determination of the value of the tax and all that. So when X dies, that is 9.1, number 1 of the Inheritance Tax Act of the Erbschaftssteuergesetz, and now we come to the tax base. That is the enrichment of the acquirer as far as it is not tax-free. That was 10.1, sentence 1 and 2 of the Inheritance Tax Act. And so we have to look through the different positions. The house in which X lived. Well, the house has to be valued with the market value. See paragraph 12 of the Inheritance Tax Act, and there we should look up for the exact rule. When it comes to the valuation here, then we have first to see that the valuation has to be made for the date of the arisal of the tax, and then normally it's the valuation law, the first part, so probably market value. But for real estate property, there is a special rule laid down in several sections or paragraphs of the valuation law. Inland real estate property 12.3, foreign real estate property 12.7. So this is the reference which we need. The result of the valuation is already there, given in the task, so we need only the reference here to the legal sources. So what we can do now is we can simply go on. So that is here in our case description 400,000. Is there any tax exemption? You know there is a tax exemption for family homes somewhere in 13.1 number. That's something with the 4 area. And so we can probably not know that by heart, so we are going to look it up. Okay. Yeah, 13.1, number 4a, donations among living persons, whereby one spouse transfers ownership or co-ownership of immovable property in the inland in the EU or EEA to the other spouse. That's not our case. We have an acquisition on ground of death, and we do not have a spouse. The acquisition by the surviving spouse or surviving life partner of a family home, no. 4c, the acquisition on ground of death of immovable property situated in the inlet and so on by children mentioned in text clause 1, number 2, or children of the deceased children, so children and grandchildren. This exemption does not apply. Furthermore, it would require that the heir takes over that house as own house and lives in it for at least the next 10 years. So all these exemptions do not apply. Now you know the house is intended to be let to tenants. So you know there is another rule, 13d, which applies to houses let to tenants. So let's look for that. Real estate property as defined in paragraph 3 is to be valued only with 90%. So the problem is the reduced valuation applies for real estate property with buildings and so on, which are let to tenants, but the conditions at the date when the tax arises are relevant, and when the tax arises, this property is not let to tenants, so we have no claim to the 90% valuation under 13d. So nothing at all applies. We have the full market value as the tax base. So number 13.1, number 4a, 4b, and 4c do all not apply. Furthermore, paragraph 13d does also not apply because the house in question is not yet let to tenants. So full market value of 400,000 is the correct tax value. Now we have B. The bank account is to be valued with the nominal value. That was paragraph 12.1 of the Inheritance Tax Act in combination with paragraph 12.1 of the Valuation Law, the Bewertungsgesetz. So 112,300. Furniture and the car to be valued with the market value. 12.1 Inheritance Tax Act says use the first part of the valuation law, and the valuation law says in paragraph 9 you have to take the so-called common value, that is the commonly paid value. That's nothing else than the fair value or the common market value. So this is here 50,000 plus 30,000 is 80,000, minus free allowance under paragraph 13. You remember there was something with a free allowance, and we should have a look to that, because the most well-known free allowance for furniture and for other movable objects is only for members of tax clause 1, but we have here tax clause 2. There was another exemption which we can look for, and we will do that immediately. So tax-free remains household property and other movable property, but in both cases only tax clause 1. Now C, household properties, chattels, movable property, and other movable property which is not exempted otherwise in case of acquisition by person of tax clause 2 and 3 as far as 12,000 are not exceeded. So 12,000 is a free allowance here. So that is what we can deduct. 13.1, number 1, letter C, minus 12,000, so subtotal 68,000 euro are taxable. Now, we have now the house in Munich to be valued with market value. That is 12.3 of the valuation law here. 800,000, but only with 90% of it. See paragraph 13d1 of the Inheritance Tax Act, because the conditions of paragraph 13d3 of the Inheritance Tax Act are fulfilled. This is let to tenants located in the inland, in the EU or EEA, and not business property. So relevant value is only 72,000 euro. Good. Now we have to add everything up. That is, because of A, we have 400,000 plus. Because of B, we have 112,300. Because of C, we have because of C, we have 68,000. Then we have, because of D, 72,000. And then that is only a subtotal, which is then, okay, 512,000. Now I really hope that this is true. 600. Now this is only a subtotal, because what we still have forgotten is the deduction of liabilities. For example, the lump sum for funeral costs. Number 3 of the Inheritance Tax Act. This is 10,300 euro. So we have a new subtotal of 642,000. Now what we naturally also have to deduct is the legacy of minus 60,000 to the Red Cross. That's under 10.5, number 2 of the Inheritance Tax Act. And so the new subtotal is 582,000 euro. Afterwards, we have now to think about the personal allowance. Minus the free allowance of minus 20,000. That was paragraph 15.1, tax clause 2, in combination with paragraph 16.1, number 3 of the Inheritance Tax Act. So we arrive at 562,000 euro. And now we have to add the former donation 5 years ago. That was 300,000 euro. And you can look that up in paragraph 14. And we should have, for reasons of certainty, and just have a small look into paragraph 14. Well, here it is, even in the first sentence already, paragraph 14.1. If the person who acquires something acquired already something from the same person before, within the last 10 years, so several acquisitions ought to be taken into account by adding their value to the value of the present acquisition. And then from the tax due for the total acquisition calculated this way, that amount of tax is deducted which would have been due according to the personal relationship of the acquirer and on the grounds of the present day's rules for the former acquisitions. Yeah? So 14.1. Sentence 1 was the rule for it. So we have now relevant 862,000. Now we need to look for the tax rate and tax for this. Well, you know, we need paragraph 19 of the Inheritance Tax Act. And now nobody can remember that. So we will have to look for the right bracket. 862,000 in tax class 2. Let's have a look. And here it is, 19.1. We have to take the bracket up to 6 million because you remember that the entry here in the first column is always the upper end of a bracket. So we are here in a bracket where tax class 2 is already liable with 30%. So we can apply 30%. So that was 30%. So that's here 30% of 862,000. That is, let me take refuge to my calculator. That must be 250,600. Now let's do the 19.3 test. That is that tax excessive or so? The last threshold was 600,000. And there was 25%, so tax there was 125,000 euro. No, 150,000, sorry. That's a mistake which I always make, I don't know why. So the distance from the last threshold is better place this into a new line here. That's 220,000, and 50% of that are 111,000. So last threshold tax of 150,000 plus 111,000 would be 261,000 euro, and the regular tax, that is the limit for tax under paragraph 19.3 of the Inheritance Tax Act. The regular tariff tax of 258,600 euro is lower, although only a bit, so the tax is 250,600. It's not capped because it would be excessive or so. Yeah, so that is the tax which applies here. To be deducted has or is the tax which was due under the present rules for the former acquisition. That had been, let's look it up. What was the former acquisition? Let's look it up. The inheritance, no, that was 56,000. So 56,000 euro have already been taken. So remaining tax burden this time for the inheritance is 258,000. 22,600 euro. Case finished and closed. Yeah, that was much, but it was easy. So thank you for watching. I hope your personal sketch of your case solution was similar to mine, and yeah, I hope to see you again soon for the next example.